Uh, Welcome, everybody. My name's Jack Kiley. I'm with MidAtlantic IRA. I'm one of the principals here at MidAtlantic. We're a provider of self-directed retirement accounts. Most of our clients have IRAs, Roth IRAs, solo 401ks, and all of these plans can be self-directed. Tonight's topic is tax deeds and tax liens. And it's been over the years, it's been a hot topic, a lot of interest in it. This is designed to be sort of introductory, quite frankly, where we probably won't get too deep into the nuts and bolts of it. Uh, Additionally, every state or every jurisdiction has a little different way of handling it. So, you have to really check there. This is designed to be educational. This is not tax advice. This is not legal advice. Um, Again, strictly educational. So if you have those sorts of questions, does this fit well into your portfolio and those sorts of things? Is it tax wise? What are the implications? Although I am a CPA, I'm not necessarily your CPA. So you should check with your advisors on that. Um, the This course for or this presentation for those of you who are also clients, we have a deeper dive for clients only. So look for that. Although I think we already had the one for tax for this presentation. But you know, in the future, you might want to dip onto that one too. Um, with that, we'll get into the topic, and it typically, there you'll hear two terms when we're talking about tax deeds and tax liens. Then, and those are the two terms, liens and deeds. And depending on what state or what jurisdiction you're in, they generally do one or the other. A tax lien is an obligation. You essentially buy the obligation to be paid, okay, the tax and the statutory rate of interest. And the deed is where they actually give you the deed to the property, okay. And although there is a cure process for the property owner to recover the property, and you have to work through that. And again, I would say you need to do your due diligence and look at the jurisdiction that you're doing this in. So where do these things arise, or where do they come from? Every municipality, state, a county has a real estate, but generally all of those jurisdictions, unlike the federal government, have to balance their budget and have to live within their means. So what happens is they budget based on the collection of taxes, and one of the primary taxes is real estate taxes. And when property owners don't pay their taxes, of course, the government is short, and they sell the liens or the deeds as a way to square their budget up. So, as I said before, every jurisdiction has a way of a process, if you will, of going through this. Some of them are online, some of them are in person. There's a different process. So I would encourage you to look at the jurisdiction that you're interested in. Call the tax office. I'm a little old school. I can get some information off the internet and whatnot, but there's nothing like talking to a person in the office. And really, the office that you're looking for is a registrar. The tax, generally, it's in the real estate tax division of the municipality. So for instance, I'm in Maryland, and I'm out in one of the western counties of Maryland. And their process is that you have to take a certified check with you. It's the price of admission to the auction, and that certified check is for $5,000 payable to the county. And if you win a bid, then they keep your check. If you don't, then you get your check back. And then if you win, you've got I believe it's 3 weeks, 21 days to settle up. But that's just the way that county or my county works. Wherever you're located or wherever you're interested in may be different. So again, I encourage you to sort of dive into what that process is wherever you're looking. Um, some states are harder than others. So again, I said I live in Maryland. Maryland tends to be a uh, consumer friendly state, meaning that it would be hard to foreclose. Okay, some other states are not as hard. So, for instance, Texas is not as hard. A lot of the states that you would imagine are a little easier. But the and this next part here is just my opinion. When you're looking at this as an investment, you're really looking at the statutory rate of interest. That's the thing that attracts people. My opinion is this is not a good way to try to acquire property. And the reason I say that is if I was a real estate owner, okay, which I am, and I had a piece of property and I didn't have the money to pay the taxes, I would be faced with basically two options, either finding the money to pay the taxes or let it go to tax sale. If it goes to tax sale, I potentially could lose the property. So if the property has value to it, I may as well sell it and then obviously keep the proceeds, pay the taxes, and be done. Okay. If it's a dog, if it's a property that is you know, bad. So, let's say there was a toxic spill on this or something on the property, and I was not going to recover anything. Then I'd let it go to tax sale and be done. But if there's value to the property, I may as well sell it and be done, as I said before. So it's the good properties that go to tax sale are probably going to be, um, the landowner, the real estate owner is probably going to find a way to pay the taxes and either keep the property or sell it. Okay. Um, which brings me to the other side of this, which is the rate of return, which most jurisdictions have a statute. Well, they all have a statutory rate of interest, and that's generally somewhere between 12 and 20%. So right off the bat, you can see that that's a pretty good rate of return, okay, on the outstanding tax debt. And you also would recover any legal fees that you would incur. And again, in most jurisdictions, there's a statutory legal recovery, and there's some other drips and drabs that you recover. So essentially, you are made whole as the investor in the tax lien or the tax deed for whatever you would incur to be paid. Uh, if the property owner sells the property, you are in second position, quite frankly, right behind the government in getting paid. So if somebody sold the property and had an outstanding lien on the property, tax lien, that would be paid before the property owner would be able to recover uh, the proceeds. So you're in about as good a position as you can be. But again, I think you're really thinking of this in terms of the return on investment as opposed to a way to acquire property. Okay. Does anybody have any questions on that? Want to kick that around a little bit? No? No. Okay. All right. So Again, the first thing that's important is to understand whether the jurisdiction has liens or deeds, and also understanding what the process is to recover, uh, the outstanding debt. The the other thing to keep in mind here is that these are generally auctions. So what happens is I've been to a few of these, and I've seen people get caught up in the bidding. And so, for instance, if there was an outstanding tax debt of 5,000 and the statutory rate of interest is 20%, if you bid it more than five, so if somebody bids five and then somebody comes back and bids six, if you pay if you pay $6,000 for a $5,000 tax debt, your incremental rate of interest is going to be something less than 20% in my example. Okay. Because if you put out six instead of five and you recover, pick a number, although it's the statutory rate based on $5,000 outstanding debt, because you paid six, what your rate of interest is going to be something less than that. Does that make sense? And I see Michelle has a question. Go ahead, Michelle. Oh, I guess that was me. I thought I saw my hand up.
There is a question in the chat as well.
Okay.
I
What's that? I don't have the chat up. What's the question?
I have a question.
Yeah, Steve can go first and then I'll read the question from the chat.
Yeah, what I like to know, like state of Maryland, because I'm from the state of Maryland as well. So, is it a bid up, bid down interest, or bid up? What is the process?
You
Like
have
when
to
you're, when
check with the
you're
you have to check with the jurisdiction. So, for instance, Frederick County is different from Baltimore City, is different from Carroll County. So, and then there could be for instance, I'm in Frederick, and the city of Frederick has a tax over and above the county. Okay, so you have to look at who's not getting paid, and then who is ultimately who's running the auction.
so in the state of Maryland, every county basically has their own set of rules.
Hmm.
Okay, all right.
Potentially. I mean, generally, when you look county to county to county, and this is just Maryland for those of you who are not Maryland residents or are not interested in Maryland, it's you'll see generally the same. Okay, at least the two or three counties that I've looked at are the same, but they all have what I would call house rules. So they've got their own little idiosyncrasy at the local level. Okay. But when you said bid up or bid down interest, I'm not sure I follow what you mean. What do you mean?
Well, yeah, well, some auctions I've looked at some auctions, and some of them are bid up the interest. So, like you're getting a bid. Like if you're bid down the interest, so what is the less that you would take? And a lot of times, the less that you bid down, you might win the auction, and sometimes it's a bid up. The more you know.
Well, generally though, isn't it what you're willing to pay,
But yeah,
not
yeah,
the interest that you're willing to receive?
yeah. Like, well, in the state of Florida, I think it's bid down, and it's like the less interest that you're willing to take for whatever is up at the auction block. So I'm from Maryland, so I want to learn Maryland style. So I was just
Right.
wondering, yeah, what is a bid process here? Um, you know, so that's what I mean,
Well, okay, so generally, my understanding is what is at least the ones that I've been to. If the outstanding tax bill is $10,500, okay, somebody would bid either, would offer 10,500, okay, and then if somebody else was interested in that, they might bid 10,600.
Okay,
Okay. All right. Because the county is going to get whatever the winning bid is. Okay. So
okay,
if the winning bid is turns out to be $11,000, it's in the county's interest, for instance. okay, to for the bid to go up, because although their outstanding debt may only be $10,500, they may get $11,000, $12,000, $13,000, whatever that is. Okay. Now, if you win at $11,000 in my example, then what happens is the statutory rate of interest is based on the outstanding tax debt, which was 10.5. So even though you paid 11 or more, what that simply means is that the rate of interest, that the incremental rate of interest that you're going to get is going to be less than the statutory rate, because you paid a premium, if you will,
Okay.
for the for the lien.
Okay.
Okay. All right.
Thank you.
So, yep. So the message to that is, if you're doing this, don't get caught up in the bid. Okay. So, although I'm a CPA and I'm pretty good with numbers, I can't quite figure out the incremental or the implied rate of interest that quickly. So a lot of times when I go in, I know which ones I'm interested in, and I know what my top bid would be, and I stay under that as best I can. But I have seen people, essentially bid themselves to a point, or I've seen auctions that are bid to a point where the incremental rate of interest is only like 4%. And I'm thinking, why go through all this for
Right.
4%? Right.
Right.
So,
Hey, Jack,
okay.
and I have a
Yes.
question. So if the tax amount is 10.5 and you bid 13,000, you're gonna get 13 grand out of pocket that day. When you get reimbursed from the landowner, when they redeem the property, they're obligated to pay you the 11 or the tax amount, or they pay you the tax and the county then gives you back the other few thousand, the difference between the 10.5 and whatever
Well,
you paid.
no, generally you get, so these are already, generally they're already, by the time they get to tax sale, they're already accrued interest of, months to even a year, okay, or more, okay. So there's already, you have to figure out what it is that you're going to get, but what you're going to get from the property owner is his outstanding tax debt. So in your example or my example, it was 10.5 plus the accrued interest from the date that he was supposed to pay and didn't, right? Up to the point that he actually pays, which could be 2 or 3 years. Okay. So generally in most jurisdictions, the tax sales are on, so in Maryland, for instance, I think real estate taxes are due in September. Okay. And this is sort of tax lien and tax deed season, is sort of at the end of the year, because all the counties and that are on fiscal years are trying to balance their books. So uh, a property that just is maybe 2 or 3 months in arrears probably isn't up for sale yet. That might, in Maryland, for instance, that might be, if you see a lien up for sale, that might be on taxes that were due in September 30, 2024, or maybe even 2023. Okay. By the way, is that the John Day?
It's what's left of him. Yes, it is, Jack. Thank you. Jack,
How you
I
been?
used to, as an auctioneer years ago, I used to do the sale in Anne Arundel County for the tax liens. And the
Hmm.
funny thing was that people would pay a crazy amount of money for these properties over and above the tax lien amount. So, and what you're saying is that it totally dilutes the amount of return you're going to get. So I
It
never
does.
understood it when I did the auction. I never bought them, but I always thought, well, why the hell the taxes are 4,000? This guy just paid 12,000 to the county or whatever it
Right.
was. And you're saying
Right.
don't do that, or if you do, be careful not to go over what the accrued interest might be, because otherwise you've just lost whatever overage you paid. Yeah.
Well, that's yeah, and it's a little more than that. So it's it's the accrued tax plus there's usually a baked in legal fee. So you'll notice, and you probably remember this when you were auctioneering, one of the big buyers of these tend to be law firms or tend to be, you know, yeah, law firms, I guess. And they'll buy tranches of them. And the reason for that is that obviously because they're in the legal profession, they don't pay, they're out of pocket for legal expenses is whatever their in-house fee is. But there's usually a statutory fee for legal. So although the outstanding tax debt in my example might be 10.5, there might be a statutory fee for processing of whatnot and I'm making this up, of $1,500. So if you bid 13 or in your example, John, you'd probably be close to being whole because you'd get, the debtor has got to at least pay the taxes and the processing fee to get out of hock. Okay.
I got you. Thank you. They're starting to
Yep, you
bundle
bet.
them now in these huge bundles, so it makes it a little bit unaffordable here, I think.
Right. Yeah. Brandy, you have a question?
Yes, thanks. Two questions.
Mhm.
So to follow up with what you just said, the legal fee will be passed on to the person who's bidding, or would no? So the
No,
person,
it's the debtor. The debtor has to pay the legal fee. You get it, okay, as the winning bid, okay? So generally when you look, and again, you have to sort of look at the jurisdiction. So usually what you see is that the outstanding debt is the outstanding debt, however much that is, okay? In addition to that, there's a statutory rate of interest that accrues, and it's usually something pretty high. It's usually somewhere in the neighborhood of, you know, 12 to 20%. Okay. And so, that's baked in. And there's also usually a statutory fee, and I'll call it a processing fee of some sort, plus there may be legal fees, but all of that needs to be paid to you by the debtor in order to recover the property.
thank you. My
Yep, you
second,
bet.
oh, thanks.
Go ahead.
My second question, this is kind of technical. So going back to what you said on overbidding, right? And then that lessens the amount that you get back. Is when they lessen the amount, is that on the overall purchase, or is the first, let's just say, is 10.5, the 6-year example?
Well, let's
Um,
well let's say for the sake of discussion, okay, by example. So if the debt, just if I can do the numbers in my head. So if the outstanding tax debt is $10,000 and the statutory rate of interest is 20%, okay? If in a year the accrued interest would be, 20% of $10,000 would be what? $2,000. Okay. So if I bid at debt amount, so 10,000, and it was outstanding a year and the owner paid me, I'd get $12,000. Okay. If I bid $11,000, if it's bid up and I pay $11,000 for that same lien and he pays off in a year, his payment is going to be the same $12,000 because his debt was 10 grand in tax and the statutory rate of interest for a year at 20%, it'd be 2,000. So if I bid 11 and I get 12, my implied rate of interest, or my, incremental rate of interest, is only 10%, right? Because if I take, or something less than that, quite frankly, because if I paid 11 to get $1,000, that's really probably 9%. Okay. So by bidding up my point earlier was, by bidding up the price, okay, of what you're willing to pay, the incremental, or your rate of interest on what you pay, is going to be less than what the statutory rate of interest is. Hopefully that made sense.
Still a little fuzzy, but I have a very direct question. So are you okay with me asking that? And then I think that will clarify.
Fire away. If I don't know, I'll tell you I don't know.
Oh, it's the same thing. So is the percentage off on the overall number, or is it on the first part that is?
It's generally speaking, the interest is on the outstanding tax debt. Okay. So in my example, if the outstanding tax debt was $10,500, that's what the interest is based on. Okay. So however long it's running until the guy pays, it's at 10,000, it's based on 10,500.
So this is what I'm trying to say. I don't think I'm. Just give me a minute. So if let's just say 10,500, and then let's just say it's 10%, right? That's how much the state is going to pay.
Let's do this so we can do the numbers in our head. Let's say it's $10,000 is the outstanding debt.
Okay. So, and then okay. And then let's just say the county is going to pay 10%. And then somebody bids above the $10,000. Would they be paying 10% for the first 10,000 and then less for the additional over, or are you paying less for all of it? Do you understand what I'm saying?
Okay, so first off, once the county sells the lien, okay, it's whoever they sell it to. So the county's done. Okay, you paid the county for the right to collect the lien. So if you paid $11,000 for a $10,000 lien, the county's going to get $11,000 and they're done. Now you have paid $11,000 for the right to receive $10,000 plus a statutory rate of interest, which is whatever the county charges. So if you look at your property tax bill that you get, if you pay it late, it'll either tell you on your tax bill what that statutory rate of interest is, or that tells you if you pay 30 days late, it's X, and if you pay 60 days late, it's Y, and if you pay 90 days late, it's another number. And basically those numbers are whatever that accrued rate of interest is. Okay. But you're only going to collect, okay, or the debtor, let me put it this way. The debtor only has to pay you whatever the stated rate of interest is. Okay. So it works the same way as if you bought a note, or a promissory note that had already been, you were not the originator of the note if you bought one in midstream. Did that help any?
No, I'm still fuzzy, but it's okay. We can keep going.
Okay. All right. We'll keep going along. All right. Steve, you got a question?
Yeah, I just wanted to know the redemption period in the state of Maryland. Now, I don't, like I asked earlier, all the counties have their own different rules. Is 6 months the rule for all of the state of Maryland for the redemption period?
I don't know the answer to that.
Oh, okay. Okay. All right.
I don't know the answer to that.
Well, what is the redemption period in your county?
Um, yeah, it's been so long since I've done it. You know, I did this like 10, 12 years ago.
Okay.
I personally, this is not my investment of choice anymore. You know,
Oh,
when I did this, you know, you see this gray hair. When I did this a while back, um, you know, there weren't as many people in it. And I think, you know, John mentioned this earlier. Now you've got big institutional guys coming in and they buy tranches of these things at the same time. Okay. And the jurisdictions are happy to sell those tranches for a couple of reasons. First of all, they may not even have to go through the auction process. So if I, you know, and you'll see this with notes too. You know, typically what they'll do is they'll sell, you know, if you buy 10 tax liens from the county, you know, there's probably three or four really good ones, and there's probably three or four marginal ones, and then there's usually two or three dogs that you may never get paid on. Okay. But you know, what the county's doing or what the jurisdiction's doing is they're bundling them together because ultimately they need the money to operate. Okay. So you know, they need to sell them because they need to balance their budget. Okay.
Jack, it's 6 months in Maryland.
Six.
Unless it's
Okay. There you go.
an owner occupied property, you can't begin the foreclosure process until 9 months.
oh, until 9 months.
Okay.
Oh, okay.
If it's owner
Yeah.
occupied property,
Oh, okay. But vacant properties is 6 months.
6 months.
Okay. Thank
Or
you, John.
investment. Yeah. Yeah. Lisa, question? Lisa Brown, do you have your hand up?
Yes, I'm sorry. I had to find the
That's okay.
button. Yes, so if you bid on the property and you get it and you collect your interest and everything, but the person does not redeem it, they don't come to pay the taxes or whatever, are you stuck with that property? Like what happens at that point?
Well, you have the obligation. Well, first of all, they wouldn't pay the interest without paying the you know the underlying debt. I mean, if I don't have enough money to pay the debt, I'm probably not going to pay the interest because the obligation is still outstanding. Um, you know, so that obligation sits out there until um, until the property, you know, is sold or you foreclose. Okay, so the ball's in your court to decide what it is that you want to do.
But she could foreclose on that property and wholesale it, right?
She could,
Okay.
yeah, yeah, if you want, you know.
Okay, but you have to go through the whole foreclosure process with the bank and
Right.
everything.
Well, it's not the bank, right?
County.
It's the county.
Oh, well,
Okay. Well, it's the
I was
debtor
just
is it's the debtor is really who it is.
okay.
So, you know, so it's a court, you know, the other thing is in some states, and this is the other thing that you have to look at, and uh, you know, in some states, it's what they call a judicial state, and the other are non-judicial states. And basically what that means is that in Maryland, I'm sure is a judicial state. So in order to foreclose, okay, or enforce payment, you have to go through a legal process to do that. Okay. In some other states, you don't have to go through the courts to enforce your claim. Okay. So, uh, you know, just that's the other thing that you want to look at. Okay.
Okay.
So
So
so these are go ahead. What were you gonna say?
So I guess what I'm trying to also understand is, so I don't think I asked my question properly. So if the debtor does not pay anything, they say, I don't have money for the taxes or anything else. I'm not paying, I'm not doing anything, but you've already put up your $10,000. So at some point, do you get that money back if that person doesn't pay, or do you have to foreclose in order to get it? And if you didn't want to
Yeah.
foreclose, that's just money gone.
Yep. Exactly.
Okay.
Yeah. So, I mean, once you pay the county's not giving you the money back. You're done, right? They're done. Okay. So if you don't get paid, you have two options. You can either sit and wait, okay? Because the lien's yours, okay? And that until something happens with that property, um, you're first in line, okay? Or second in line because you're behind the feds and the third in line in the state, okay? The other is you have the right to foreclose. Okay? So if you go through foreclosure, and again, it depends on the property, and this is where you need to do some due diligence. Um, it may not, it may not be a property that you want. Okay. Um, so you have to, it may not be worth the cost of going through all of that.
Okay,
Okay.
I understand. So when you
Yeah.
select properties, do you only select properties that if push came to shove, you'd be willing to keep it and go through
Well,
foreclosure?
yeah. So if it's me and I was doing my due diligence on this, I would be looking at a couple of things. So first is the state or the jurisdiction that I'm looking to invest in tax liens. Okay. And again, some jurisdictions and some states are more favorable than others. So, for instance, I probably wouldn't buy, and this is just me. I wouldn't buy a tax lien for instance, in California, because they're probably so consumer friendly and so debtor friendly. I may never be able to go through foreclosure, or it may take me several years to actually get there. Okay. Other states, for instance, years ago, I did one in Florida. Florida was very easy. Okay. Um, North Carolina is it used to be, and I think it still is, a deed state, meaning that you pay for the deed. So it's not just the outstanding taxes. Usually it's something that more closely approximates property. But if you buy the deed, well, not usually, always the owner of the property has a right to cure, meaning that they have the right to be made, to buy and I'm using this term loosely, buy the property back. So um, you might, you know, and there's a bidding process there. So you may win the right to foreclose on the property. And I know I'm not going to say this correctly, but basically, if you if you bid and you win, okay, then you go to foreclosure and you have the right to foreclose. The property owner has the right to effectively counter that. And if they come back and they counter with more money, okay, then this whole process starts over again until one of you settles. Okay. So you may be chasing, good money after bad. And basically what I'm saying here is it gets back to understanding whatever the process is in the jurisdiction that you're looking at. Secondarily, evaluating the underlying property. So if you're a person who's in real estate and you understand property, you could probably assess that very quickly. That said, I wouldn't necessarily go by pictures that you see online because you don't know how old those pictures are. I would probably pay somebody to drive by the property or look in the windows as opposed to just accept what you see online, or do it yourself. So, if like I said, I bought one in Florida. I live in Maryland. I wasn't going to go to Florida. I paid somebody locally in Florida, what's called a BPO, to drive by the property and make sure that it was, the pictures that I was seeing was actually what the property looked like. The other thing that you'll see from time to time is that the same, the same properties are always up for tax sale year after year after year. Well, that tells you one of two things. Either the person habitually doesn't like to pay their bills, okay, or there's something wrong with the property because he's not paying his taxes and nobody's foreclosing on the property, right? So why is that? So, you want to sort of dig into all these things. But again, as I said before, this is not necessarily this is my opinion, okay? This is not necessarily a way to acquire property. This is a way to invest in something that gives you a higher rate of return than, what a bank is going to give you. Steve, got a question?
That's going to say to add what you're answering her question. I mean, would you say that like you should have a good exit strategy, before after you do your due diligence to make sure like what are you going to do with this property? Are you just for the interest or are you looking to wholesale? Would that be
right? Yeah, but you got to, here again, if you're going to wholesale, you got to have the property in your hands first, okay? Because you don't, you know, when you wholesale, right, you basically have the contract, you have control of a contract, right?
Okay. Right.
Okay. And until you actually own the property, you don't have control of anything here.
Okay.
The only thing you have is a right to be paid.
Your interest, right?
Okay. Right. But it doesn't say when until you actually go through foreclosure,
Okay.
if that makes sense.
Yeah, it does.
Okay.
Perfect sense.
All right.
Thank you.
I'd be a little careful about trying to wholesale something on top of that. So anyway, I think we pretty much kicked this in in the head. Uh, the we do have, all of this said, we do have a lot of clients that own tax liens in their retirement accounts, and it's not a hard investment to hold. It's attractive again because the statutory rate of interest is something higher than what you might get at a bank, and also there's not much variability in price. You know what you paid, you know what you're going to get. It's more an issue of when you're going to get it. Okay, so it's a pretty, once you acquire the deed or the lien, it's a fairly passive investment with respect to the retirement account. Um, some of the um, I'm just looking through my notes real quick here. Uh, we talked about due diligence, but again, it it tends to be for the payment of interest. So if you were looking to do this in a retirement account, the first thing you would do, if you don't already, is open a self-directed account, preferably with us if you don't have one. And so there's a funding process. You need to complete an application, fund the account, which is usually by transferring funds from another IRA into the IRA with us. And at the same time, you can, you're looking at where you want to bid. Okay. And you want to understand whatever the rules are, the ground rules are in that jurisdiction. And at that point, you would call, at least with us, you'd call the acquisitions team that we have. That's where investments are started there. And we want to know before you really get too far down the line. A lot of other providers, they don't really want to talk to you until you are ready to pull the trigger on something. And with tax liens particularly, that can be really, really hard, given the time frames. So usually while you're funding the account, you're researching, you're selecting the location and whatnot, and that transfer process from other accounts might take a couple of weeks. So this isn't the kind of investment where you can open an account on Monday, decide that you're going to go to a tax sale on Tuesday and be able to do all this. Okay, so you gotta think ahead a little bit, and you're probably, you know, legitimately you're probably a month out from the time that you start the process. Okay. Once you know where you want to bid or a lien that you want to acquire, you talk to our acquisitions team. We have a form uh, called a buy direction, and basically that tells us what it is that you want to do. Okay. It might identify a lien, it might identify a tax sale, but the acquisitions team will help you with that. If you need funds up front, so for instance, as I was saying, in Frederick County, you need a certified check to go to the auction. We would issue a certified check payable to the jurisdiction, and we would send that to you so that you could actually take it in and go through the bidding process. If it turns out that you don't win, you just send us a certified check back and we put it back in your account. Okay. If you happen to win the bid, however, the whatever the process is for uh, additional payment or refund, generally it's additional payment. You would requisition that from the account. Would go directly to the county or the jurisdiction, and the lien would be titled in the name of your IRA. So not your name, not our name, but in the name of the IRA. So basically, what that tells anybody that's looking at it is that the retirement account owns the lien is in the name of the retirement account. So it's titled directly there. When the debtor pays, the interest along with the principal amount would go back into the retirement account, and there's no tax on that. Obviously, it's tax deferred. If you need to pay for legal fees, for instance, or any other expenses attendant to the lien needs to come out of the account. Okay, so you can't pay those personally. You want to pay them out of the account because again, the investment is in the retirement account. It's not a personal investment, so you don't want to commingle those two things together. Um, and that's if you decide to sell it to somebody else, which happens from time to time. Uh, basically, you would issue a sell direction letter, which just says, "I want to sell the lien to Steve," for instance, and then Steve would pay the retirement account. So that's in a very sort of general sense, that's the process. Does anybody have any questions on that or thoughts?
I have a question. I think you answered it, but I just want to make sure I understood what you said. So,
Hmm.
I've bought several tax liens in Baltimore City. I've only ever bought in Baltimore City. I
Okay.
never participate in the auction. I always just shop off of the leftover list. So
Hmm.
it sounds to me like I could still do that with the self-directed IRA. I would just ask for the check from you guys. You give it to me. I take it to the to Holiday Street, get the lien and start the waiting period. And then,
Hmm.
okay, I understand that. So the second question is, if we get to the point of foreclosure where I have to foreclose on the property, and then I take possession of the property, the couple $1,000s that I have to you pay to foreclose, I would then come back to you guys and get another check for that, right?
Right. Right.
Okay. So I
Hmm.
foreclose on a property, then after foreclosure, say I sell it immediately to another investor or whatever. The money that I make off of that sale goes to the IRA, right?
Correct. Yep.
Okay. Okay.
So let's sort of break down each part of this. So when you look at the leftovers list, okay, and you contact the office, what do they normally tell you?
When I contact the city,
Yeah, I'm sorry, the city. Yeah.
yep. So when I shop off the leftover list, I pick what address I want and I go down to the city office and I give them usually a personal check.
Hmm.
And you sign, fill out the paperwork, sign it, and it's just that. The thing about Baltimore City is the leftover list usually comes out around September, October. The tax sale
Hmm.
happens in May. So by the time I'm chopping off of the leftover list, the 6 month waiting period is from the time of auction.
Oh,
So
okay. Okay.
so I'm very close to that 6 months period. So I can just take that straight to the attorney that I used to do the foreclosures, um,
Hmm.
and start the process.
Okay. So what you would do is you're looking at the leftovers list, and let's say you find one and it's, pick a number, whatever that amount is,
Mm-hmm.
and it's payable to who? Baltimore, City of Baltimore?
Baltimore City, yep.
Okay. So you would, you know, get with the acquisitions team here and you would say, basically I want to purchase the lien on 125 Main Street. Okay. Uh, they'd they'd help you with the buy direction and they would send you a check, in this case, payable to the city of Baltimore for that property. So when you go to the city, you want to make sure that the property is vested or titled to the IRA. So
Okay.
it would read, MidAtlantic IRA FBO, which stands for the benefit of, excuse me, your name, Wiley Brown,
Mm-hmm.
comma IRA. Okay. So and that becomes important because that tells anybody that's looking at that it's the retirement plan that owns that obligation to pay. So the next step would be to, I assume your lawyers, you know, don't work for free, right?
Right.
So you would, get complete a payment authorization and say, look, I need to pay, you know, Walker Brown and Johnson, $2,000 retainer for to start the foreclosure process. Okay. So we would send either to you or directly to Walker Brown and Johnson a check for that amount of money. Okay. And then they work through the foreclosure. Once the property is foreclosed on, now the property is actually titled to your IRA.
Okay.
Okay. So it would be, it'd be titled to the IRA. And then if you sell it, or you wholesale it, whatever it is that you do, however you dispose of the property. And then at that point, the proceeds on sale would come back into your IRA.
So this is interesting because what if I don't dispose of the property? What if I walk through and say, you know what? I could throw a couple dollars in here and use it as a buy and hold, rent it. Would my IRA then take the monthly rent and just stack
Yep.
it? Oh my goodness.
So what you would do, actually, look at that. She likes this. Okay. So, so basically what happens, the property is titled to the IRA.
Mm-hmm.
Okay. So if you are going to self-manage, okay, you get a tenant. The tenant, the tenant is the tenant. The landlord is the IRA. So they would pay the IRA directly, or we have clients that do it a lot of different ways. They may, some clients require the tenants to ACH the funds in, okay, on a monthly
Mm-hmm.
basis. We have others that go and collect the rent checks, okay, because they want to, it's just the way they do it. And then there's others that just mail them into the office, okay? So regardless of which way you do it, if you're going to go collect checks, for instance, you want to make sure again that they're payable to the retirement account, not to you, okay? And then you just forward them on to here. Most of our clients really, quite frankly, have their tenants either mailed directly or ACH directly to the account. And you have online access to your account here, so you would see it in the account the next day in your IRA. Any expenses attendant to the property, so real estate taxes, if you have HOA dues, insurance, you have insurance on the property, obviously. Those things have to be paid out of the account. But, other than that, you're up
And
and running.
repairs. So,
Come out of the account. Right.
oh,
Yeah.
awesome. Okay.
Yeah. Yeah. So
Thank you for that.
you bet. Steve, question?
Yes, you were mentioning the process for OTCs, but what is the process for online auctions? What does your company, what's the process? If I want to participate in an online auction, how would I go about that with your company?
Well, it depends on what their process is. So if there is and that has to be worked out in advance. So a lot of times, um, I'm trying to think of one that we did recently where the person won the bid and they had, I think, like 5 days or something to remit payment, is my recollection. Okay. So you win the bid, you issue us a payment authorization and or a buy direction, and we pay or wire the money. Generally at that point it's wire it to the jurisdiction.
Oh, okay. Okay.
Okay.
One more question.
Sure.
This is a greedy question. So currently I manage my own rental properties, right? I just manage
Yeah.
them myself. So if I end up holding a rental in my IRA, self-directed IRA, do I get to
Hmm.
charge my IRA for managing that property? Okay.
No, no.
Okay.
No, if you so there's a group of people, and we should have talked a little bit about this up front. So with respect to retirement accounts, there's two broad sets of rules that you just need to be mindful of. The first set deals with what the retirement account can invest in, and this is any retirement account. This isn't just IRAs. This could be solo 401ks or SEP simples. Anyway, the and the IRS has a very, very, very detailed list of two items that a retirement plan cannot invest in. One of them is life insurance, and the other's collectibles. Okay, so there's a couple of other investments that, at least at the moment, although um, they're not on IRS's list because, for instance, cannabis assets. Okay, now in Maryland, you could own or invest in a dispensary, for instance, right? But because pot is illegal at the federal level, it's and this is a federal construct. At the moment, it's what we call administratively not feasible, which is just a fancy way of saying the banks won't let us do it. Okay. So, but that's from time to time, you have a couple of others. So anyway, very short list of things that you cannot invest in. Anything not on that list is fair game. Okay. So obligations of all sorts, tax liens, secured loans, unsecured loans, you know, are all fair game. Okay. The other set of rules deals with who the IRA or who the retirement plan can transact business with. So, transact business is any financial transaction and a couple of other things where either the disqualified person or the retirement account is getting the benefit of the other's financial wherewithal. So, for instance, I'm disqualified with respect to my IRA. If I buy a property in the IRA and I borrow money to do so, which I can do, okay, but I cannot personally guarantee the loan, because if I do that, then I am giving the retirement account the benefit of my financial wherewithal. Okay. And this works in reverse too. So for any of you out there who are lucky enough to be under 59 and a half, which is the federal retirement age, if you go and you buy property personal residence, for instance, you fill out a disclosure form that has all your assets and all your liabilities and all those things, right? And they always ask you for your what you have in your retirement accounts. The underwriters, if you are under 59 and a half, they are not allowed to consider that for repayment of the loan. So you could be 40 years old, not working, but have $10 million in a retirement account, and you will not get a loan on a property. Okay. Because they can't consider the earnings from the retirement account as to pay the loan. Okay. Because if they do, now the IRA in this case is giving you a financial benefit, and that blows up the IRA and makes it immediately taxable to you. So that works in both directions. So getting back to your greedy question, if you're getting a management fee, now the retirement account is paying you, and that's verboten. Okay. So those disqualified persons, a lot of this looks like self-dealing kinds of things. So they fall into three groups. First is family members. So if you sort of reach out there in space and put a dot, and if it's your account, you're the dot, okay? And you draw a vertical line through the dot. Anybody that's on that vertical line is disqualified. So your ascendants, descendants, spouses, okay? So it's just that vertical ascendancy, descendancy. Anybody that's on the horizontal family tree, so aunts, uncles, nieces, nephews, brothers, sisters, they are not disqualified. It's just that ascendancy, descendancy. Okay. Second group is people who are fiduciaries to the account, or people who work for the account. So for instance, if your account is with us, I could not buy a piece of property out of the retirement account because I work for the retirement account. Okay, I'm too close. If you have a financial advisor that advises you on that account, okay, not on your other assets, but on that account, then that's disqualifying. Okay. So as long as you stay clear of those two sets of rules, you're good. Okay. Any other questions?
Yeah, I have one. So if I own real estate, can I sell my real estate to my self-directed IRA? Can I sell it to my self-directed IRA, or is that prohibited?
That's prohibited because you own the property. Okay, so you're the dot in my example. Okay. So because you're prohibited, the IRA cannot buy anything from you or sell anything to you. Okay.
Okay, I get it. I
And
get it.
and these, yeah, and these, if you think about it, especially with things like real estate, one of the things that the government doesn't really want to get in the middle of is valuing property, for instance. Okay. And these rules are designed to ensure that as if you don't pay enough, right? That you pay
Right.
your fair share of taxes, that you're not able to shift assets or money from one generation to the next. So for instance, if you had elderly parents who owned a piece of property that they had owned for, maybe they bought it at, a farm out in, Oshkosh for $20,000, 50 years ago. And, you want to keep it in the family, but you want to sell it to the IRA, and you're going to sell it to the IRA at like 35, even though maybe the fair market value is, pick a number, $500,000. That's the thing that the government is trying to
Prevent.
yeah, exactly. Prevent. Thanks.
One other question, real quick. So, like, I buy a piece of property, right? And so, say if my sister-in-law is a real estate agent, and I want her to sell the property for me, can I do that?
Yeah. So if you think about that hierarchy, so if it's your account and you're the dot and you draw that vertical line, your sister-in-law is out here somewhere. She's on the
Okay.
horizontal line. So
I'm with
she's, married, married
family. I got
to a
it.
sibling. Right. So that's
Okay.
fine. Yeah.
Okay. Thank you.
Yep, you bet. Anybody else? Other questions? Thoughts, comments? Okay. Um, that's really all I had tonight. What I would, if you have other questions, I wouldn't hesitate to reach out to us. If you're like me, generally you think of these things in the middle of the night. Best thing to do is write them down, email us with your questions. Don't call us in the middle of the night. Um, what's it's a info at or hello at, Siobhan? Can't hear you.
I said it's hello at MidAtlantic IRA.
Got it. Hello at MidAtlantic IRA, and we'll get those questions answered for you. If you think you need something a little more in depth, don't hesitate to set up an appointment and talk to somebody in the office. That's always sometimes that's a better avenue because you can, usually one question leads to another, leads to another. Uh, so that might be a better option. If you look for our future emails regarding upcoming meetups, where we hold this every month, with the exception of December and in August. Next month's topic is actually tax. We always do a year-end tax update, and this year, between the what is it, the big beautiful bill, and there's a fair amount of retirement plan updates from something called the Secure Act, which was passed a couple of years ago. So that keep that on your radar screen. We're going to be out in Ohio next week, or this weekend actually, at Ohio RIA has a big conference, real estate conference. It's about, I think about 1,000 attendees, give or take, and out in Cincinnati. So maybe that's on your radar screen. Um, so anyway, we're out and about. Don't hesitate to look us up if you see us in the event. Stop by, say hi. Um, Anything else we got, Siobhan?
I don't think so. Think you covered it.
All right, one in a row. So with that, I wish everybody a good evening. Thank you for sitting in, and hopefully you got some value out of this. And I hope to talk to you all soon. Thank you very much. Good night.